Welcome into a brand new episode of WSI TV. Enjoy the show.
Hi guys, welcome back to another episode of WSI TV. We're here for Jim's Market Update, and I'm joined as always by Jim. How are you doing today?
Hi, thanks for having me.
Yeah, absolutely. So we're going to jump right into things. But first, I have to remind you to go on the WSI TV website. It's WSITV.com and sign up for our free daily newsletters and subscribe for access to the WSI TV vault for free. So let's just get right into it. So we've got the S&P 500 behind us as always. And it's still looking good. So
yeah, I mean, since we called a brand new bull market, I hate to sound like a stock record, but it's good we have this fresh recap every week. In September the 9th, my proprietary system said, brand new bull market, and it's been up and away ever since. Week after week, we keep saying, well, we are due for a correction. I'd really like to see a healthy correction. We can see here this aggressive uptrend of its average here, that red line, but also it's way above that aggressive red line, and it's definitely running hot right now, but no reason why it can't keep running hot. What could we see in the near future that could precipitate this well-earned, healthy correction? I mean, we're coming into earnings season right now. That can always have a volatile turn here and there, but we'll see it when we see it. And there's no real evidence as yet of this this kind of little bit of a level off and rolling over, that sort of thing. What is also in the stock market's favor is the banking stocks, which were typically more of a healthy leader for things, because I think the so-called FANG stocks, the big tech stocks like Facebook, Apple, Netflix, Google, they've been driving a lot of the kind of holding the market up for a long time with this. So and they're kind of a mixed bag right now. So it's interesting to see the banking stocks, the banking sector, which is like more of a truer, healthier gauge of things, starting to really join the party in fashion now. So that's what's going. That's what's definitely going for the market, and it could be predicting a good earnings season for banks.
yeah, so we actually have a couple stats on the FANG stocks. We've got Facebook, Amazon, Apple, Netflix, and Google are the big names to look out for. But now everybody's saying that there's FAMG, which is FAAMG, and it's we're just replacing Netflix with Microsoft, because Microsoft is a bigger mover than Netflix these days.
Right.
And together, that new group of stocks has contributed 4.3 trillion to the market in the last year.
Interesting, right?
And that's more than the UK stock market as a whole. So big numbers.
Massive, huge, world dominators. In terms of it, it's not like they've got anyone who's going to replace them. They're arguably too big of a monopoly, but hey, the stock market loves them for that.
Yes.
But it's interesting to see here's Microsoft coming back into the game, because it was obviously out in the woods for a long time, smoked by Apple. So it's interesting to see. It doesn't spell as nice a name as FANG, but hey, if they want to replace it, then that's an interesting point, and that's been a good stock of ours. I think we've traded that a couple of times as well. But it's a tech stock dominator bag.
Yes.
And it's which is a little bit of an artificial skewing thing if it's been driving the market. And a lot of critics of the bull market that's been going on for years now, minor, lesser couple of interruptions along the way, beginning in 2009, have been saying, well, this isn't the real stock market rally because it's just got these artificial dominators behind it. But a rally is a rally, and we trade it. Yeah. But as I say, what's really starting to come into now is the bank stocks are saying something else. Not so much the case with other things we're seeing underneath all that, though, that we're possibly going to talk about today, such as retail and energy, and the retail sector is very sluggish. And one could argue that's a measure of the real economy. That's the real Main Street average person measure. Why aren't they? If this is all so great, why aren't people out spending money, affecting the retail stocks? And maybe that could be a lagging factor, because people tend to spend depending on how confident they're feeling, about things generally. And so banking stocks might be, could be a leading indicator in this case. Especially if you continue with our real estate thesis, which has been, I think for the 2021-22 could be strong years for real estate, and that's one of our big themes for this year actually. And that, of course, is going to affect the consumer.
Yes.
Because if people, it's not even like it's almost an illusion. If your house is going up in value, your bank account actually hasn't got any more zeros on it, but you feel wealthier as a person, more confident about going out spending. So we could be seeing the consumer coming late to the party.
Absolutely. Yeah, and general consumer spending is up in the general market, but we're not seeing it funneled into the traditional retail stocks.
Right.
We usually
not yet.
So it's an interesting discrepancy there.
Right. There's definitely a mismatch that is a case for the bears, you might say.
Yeah. Yeah, and then along with that, usually when employment is high and unemployment is low, you would expect people to be secure and outspending that money.
Right.
But we haven't seen that. Unemployment is at its lowest rate ever. Employment is up. We've gained artificially 145,000 jobs in December, and that rate is expected to stay the same through January. So according to the numbers, everything is rating high.
Yeah. And the numbers are, you make a good point, Lee, the numbers are skewed. I mean, for example, the government's always trying to make statistics look good. Doesn't matter who it is, and every administration is the same. They all play the same game. Little tricks like, for example, the numbers such as if you've been unemployed for a certain amount of time, you're not counted in the stats anymore.
Yeah, so all really good points, Jim. So moving on, we're talking about the 2020 election cycle, which is a big thing in the news right now, and is going to be for the rest of the year. And usually we see the election cycle have a big effect on the stock market, but so far we haven't seen that so much.
Yeah, that's very interesting because the stock market likes certainty, and we, as I say, heading into an election year, which is could have a dramatic effect on things like stocks. We've got people like candidates like Elizabeth Warren who are directly, openly saying there's going to be a wealth tax. The stock market should be hating that, even the possibility of such a thing. But right now, either the market is just still on its Christmas binge and is blind to it. It's hard to imagine though. I mean, typically stock market's looking about 6 to 9 months ahead, which kind of puts us right there at the early November election. So it's almost acting as if it's got nothing to worry about. Obviously, it likes things like the Trump corporate tax cuts down to 21%, stuff like that. So it likes that. So it's acting as if nothing's going to change, which could be the case with a more moderate Democrat candidate. So it's acting like business as usual. But a couple of things though we touched on earlier, that the retail, the man in the average person in the street, they're not acting confidently according to the retail stocks, and they're the voters. So we could be seeing, the stock market's thinking one thing, but the voters, the people who actually count at the end of the day, they tend to vote with their pocketbooks. And while they may not be unhappy, they don't look euphoric either. But that could happen later on. So it's a very interesting situation. It's not at all acting like, we're going to see, any kind of dramatic change as far as the stock market's concerned.
Yeah, so it's an interesting discrepancy. And no matter what happens in the outcome of the election, we are going to see changes, at least in specific sectors. So we're looking at energy, healthcare, the areas that are really influenced by new administration.
Yeah, and energy is going to be one, that could be, particularly the things like, big companies like Exxon and stuff like that, which could, under it, if it's more of a Democrat shift, they might be worried about something like that. And indeed, stocks like that, we're looking at coal sectors right now. Some of the Exxon stocks like that, they're definitely not happy. So there could be another, the chart's not looking good. So there could be another story under the surface here, which this may not be telling us much about what's coming. But then if you look a bit deeper, retail, energy aren't very confident at all, which could be telling a different story.
So do you have any advice for people looking at the stock market going into the new year?
Yeah, I mean, just keep tuning every week. We're constantly updated. We got you in on September the 9th, and we'll let you know when to get out. We just we ride this as long as it's profitable, and don't try to second guess it. It's going to be a very interesting year, and I keep saying it week after week, but it's not I'm not going to predict a correction, but don't be surprised if we see one, and it could be a sharp, you know, triggered off by some piece of news it doesn't like. It could be a dramatic, a very sudden correction. But you know, we're paying attention to this every week, and as long as it stays in its uptrend, stays above its very aggressively rising moving average now, it's going to be in good shape and a very healthy thing, and a great trading opportunity.
Yeah, absolutely. So thank you as always for joining us.
Thanks for having me.
All the good information. We'll see you guys next week.
See you then.
Thanks for watching the latest episode of WSI TV. Be sure to visit WSITV.com where you can subscribe for free with no contract and gain instant access to the secrets of self-made millionaires via the WSI TV Vault. So go ahead and claim this gift for free now at WSITV.com.